Hey guys, the purpose of this video is to discuss differential analysis. Differential analysis, sometimes called incremental analysis, analyzes differential revenues and cost to determine the differential impact on income of two alternative courses of action. So we can take a look here. These are some of the common decisions that differential analysis can be used to help with respect to making those decisions. Leasing or selling equipment, discontinuing an unprofitable segment, manufacturing or purchasing a needed part, replacing fixed assets, processing further or selling a product as is, or accepting additional business at a special price. We need to keep in mind that costs that have been incurred in the past are not relevant to the decision. These costs are called sunk costs. So these are kind of like water under the bridge. We've already spent the money. It's the expenses have been incurred, and there's nothing we can do about it now. So going forward, we don't need to, when we're evaluating two alternatives, we don't need to even consider these sunk costs because there's going to be no difference between the two alternatives. Differential revenue is the amount of increase or decrease in revenue that is expected from a course of action as compared with an alternative action. And differential cost is the amount of increase or decrease in cost that is expected from a course of action as compared with an alternative action. So what we're really focusing on is the differences between two different courses of action. So there's going to be some things that are going to be the same. That's not our focus. Our focus is on contrasting the two decisions to understand which one's going to lead to the company being more profitable. And differential income is the difference between the differential revenue and the differential cost. So differential income indicates that a particular decision is expected to be profitable, while a differential loss indicates just the opposite. So this is a pretty simple example here, but let's just assume that perhaps we were thinking or considering replacing tables in a restaurant with a salad bar. So there's going to be a lot of things that would be the same, but the difference in revenue here, we can see the differential effect on the revenues is going to be a $20,000 difference. So we expect we can bring in $100,000 with the tables and $120,000 of revenue with the salad bar. The tables, the costs are going to be less with sticking with the table, but and it's going to be more here, $5,000 more in order to have the salad bar, so there's a difference there. But in the end, we would be $15,000 better off to replace the tables with the salad bar, right? So that's the differential income down here at the bottom. This is the differential revenue, and these are the differential costs. Okay, let's take a second now to discuss leasing or selling. So on June 22nd, 2014, Marcus Company is considering leasing or disposing, aka selling, the following equipment. The cost of equipment is $200,000. It has $120,000 of accumulated depreciation, so at this point the book value is $80,000. But keep in mind that the $80,000 book value of the equipment is a sunk cost because they've already the equipment's already been purchased, and yes, we are depreciating it, but we've already purchased the item, so that's water under the bridge. And sunk costs that have been incurred in the past cannot be recouped and are thus not relevant to future decisions. So if we lease this out, we can bring in $160,000, but we're expected to have $35,000 of repair, insurance, and property tax expenses during the life of the lease. Okay, and once we're through with it, there's going to be no residual value, right? There's going to be no resale value in this example. Or we could sell this thing for $100,000 and we're going to have to pay somebody a 6% commission. Those are our two alternatives. We can either lease it to someone or sell it to someone. Let's take a look and analyze what makes more sense. So if we were to lease this out, we have $160,000 of revenue that can be expected. $35,000 of property taxes and other expenses were given to us in this example. So we have $125,000 of income. that is in comparison here with the $100,000 if we sell it minus the $6,000 of commission. That was 6% times $100,000 for $94,000 of income. So we have the differential revenue here is the negative $60,000. Just in comparing these, there's a $60,000 difference between the two. There's a $29,000 worth of differential costs, so $31,000 of differential income. So in this case, it makes sense, obviously, to go ahead and lease out the equipment, right? Because the $125,000 is better than $94,000. We would rather have $125,000 of profit versus $94,000. Okay, management may consider discontinuing a product or segment of a business that is generating losses. Based on the information in the condensed income statement on the next slide, management of Battle Creek Cereal Company is considering discontinuing bran flakes. Assume that the fixed expenses will not be affected by the decision. Okay, remember those fixed expenses? We're assuming that they are not going to be impacted based on whether we discontinue a segment or not. All right? So let's take a look here at these different products we have. We have corn flakes, toasted oats, and bran flakes. We have our sales, then we have these variable and fixed cost of goods sold. So we have our gross profit. We have our operating expenses split between their variable and fixed components. And down here at the bottom we have our income, or in the case of bran flakes, our loss from operations. So at first glance, when we first look at this, we're thinking, hey, look, we're losing $11,000. We should axe the bran flakes. We should get rid of those, right? That's the first thought that comes to mind. But remember, those fixed costs are not going to be impacted. So perhaps all of these three different cereals are made in the same factory building, and whether we make a lot or a little or different whatever combinations, it doesn't matter. That cost is going to stay the same. So we need to understand that those fixed costs are going to behave differently from these variable costs. If we eliminate this segment, these variable costs here of $25,000 and here of $60,000 are going to go away. Okay, so maybe those variable costs, they vary with respect to the levels of activity. So maybe that's bran flakes, so the ingredients that go into that, maybe there's a little sugar, flour, water, whole grains, whatever. So if we're not making those, then those costs are going to go away. But these fixed costs are going to stay. So the $20,000 is going to stay, and the $6,000 is going to stay, because we just would have somehow come up with a way to allocate those fixed costs amongst these three different product lines. So just because we eliminate the bran flakes, we're unfortunately not going to be able to eliminate those fixed costs. So what we're going to see here, if we eliminate the bran flakes division, what we're going to have is no revenue coming from it, because we're not going to be making them anymore, but we're still going to have those $26,000 of fixed costs. They're not going to go away. So what we can see here is that we're going to be worse off if we get rid of the bran flakes. If we keep the bran flakes, we're losing $11,000. If we discontinue them, we're losing $26,000. So we're $15,000. We'll be worse off by $15,000 if we eliminate those bran flakes. This is why a solid understanding of variable and fixed cost is something that's very crucial to making these types of business decisions. Now let's discuss whether we should make or buy. So companies often manufacture products made up of components that are assembled into a final product. Should they make or buy the part? So just think about your cell phones and all of the components that are in there. Whether you have an Apple or an iPhone or Samsung or whatever brand your cell phone is, there's lots of different components. And those businesses, the phone makers, have to decide whether or not they're going to make those parts themselves or if they're going to purchase them from other companies. An automobile manufacturer has been purchasing instrument panels for $240 a unit. The factory currently operates at 80% of capacity. Assume that the fixed factory overhead cannot be eliminated by purchasing the panels. The cost per unit of manufacturing a panel internally is estimated as follows. So if we're making this internally, we have direct materials of $80, direct labor of 80, variable factory overhead of 52, fixed factory overhead of 68, for a total estimated cost per unit of $280. Now once again, keep in mind that this fixed factory overhead is not going to go away just because we decide to purchase it instead of make it. Alright, so here's the alternatives. If we purchase it, it said $240, we could pay $240, so that's the differential component right there for that. So we can purchase it for $240, but remember that $68 of fixed cost is not going to go away, so we're going to have the $240 purchase price, and that fixed cost is still going to be there. Just because we decide to purchase this one component doesn't mean that we're able to get rid of some of the fixed costs that might go along with running the factory. Okay. Now, if we make it ourselves, we're spending $80 on direct materials, $80 on direct labor, $52 there on variable factory overhead. That 68 is going to be around also whether we make it or if we buy it. The 68 is going to stay the same. So there's no differential cost there, is there? There's not. So we're looking at $280 to make the panels and $308 to buy the panels. Okay, so we'd be better off if we make these panels in this case instead of purchasing them, right? If they were more, if this ended up being more than $308, it would make sense to buy them. But in this case, it's less than $308, which is the purchase price. So we'd be $28 per unit better off if we make them ourselves. Okay. So it's a very common decision for a business maker to have to make as to whether they should replace a piece of machinery or equipment with a new one, or try to milk some more miles out of the old one. So let's take a look here. The book value of the old one is $100,000. So remember, our book value is the cost minus accumulated depreciation, or this is the undepreciated cost. But this, once again, remember the book value, we've already purchased it. Despite how we decide to depreciate it, we've already committed our resources to this. Okay, so the book value is going to be a sunk cost. The estimated annual variable manufacturing cost are going to be $225,000. The estimated selling price is $25,000, and the estimated remaining useful life is 5 years. Alternatively, we could purchase a new machine for $250. The annual variable costs are going to be $150,000, and it will last for 5 years. So, let's take a look here. If we continue with the old machine, we're not going to have the proceeds from selling it if we continue and use it until it's not worth anything. But if we do, at this point, replace the old machine, we still think we can get $25,000 for it. So there's some differential revenue for you there. Let's take a look at the cost. There's the $250,000 purchase price. If we decide to buy this thing, which we haven't yet, okay, we have not, so this is not a sunk cost because we haven't decided if we want to purchase it or not. But if we did, that's going to be a $250,000 outflow. Take a look here at the difference in the variable cost over those 5 years. There's a $375,000 difference there. Okay, so the total cost, there's a difference there of $125,000. So we're looking at $1,125,000 of total income. In this case, this is all just expense, really, if we continue with the old machine. And we're looking at $975,000 if we replace the old machine with a new one. So we would be better off to have $975,000 of expense loss versus $1,125,000. We'd be better off by the differential income here of $150,000. So in this case, we should replace the old machine. Let me just mention this briefly. You've probably heard this discussed in one of your economics courses, but the revenue that is foregone from an alternative use of an asset, such as cash, is called an opportunity cost. And although an opportunity cost is not recorded in the accounting records, it is useful in analyzing alternative courses of action. For you to attend college and to take your time right now to be watching this video and attending class and doing your homework, there's an opportunity cost there. You're missing out on time that you could be working somewhere and making money. You're missing out. It doesn't always have to be measured in dollars either. You're missing out maybe on time you could be spending with your family, right? So those are all examples of an opportunity cost, and those are not recorded in the accounting records, but we need to keep those in mind when we're making decisions. Okay, let's discuss processing or selling. In some cases, a product can be sold in an intermediate stage of production, or it can be processed further and then sold. So we can take oil, process it a little bit, and make it into kerosene. We could sell it at that point, or we could process it even further and sell it as gasoline. Okay? So we're going to have to choose between selling it while it's kerosene or processing it further and selling it as gasoline. So in this case, we have a batch size of 4,000 gallons. The cost of producing the kerosene is $2,400 per batch, and the selling price is $2.50 per gallon. All right? Now, the kerosene can be processed further to yield or into gasoline as follows. We can take 4,000 gallons. Some of it's going to be evaporated though, okay? So less evaporation. So if we take this 4,000 times the 20%, that means we're going to lose 800 gallons there. So we'll have an output of 3,200 gallons. The cost of producing that gasoline, that extra batch, is going to be $3,050, and the selling price is $3.50 per gallon. So what makes more sense? Should we sell this as it is as kerosene, or should we take it one step further and process it into gasoline and then sell it? So remember, if we sold it as kerosene, we could sell it for $2.50 a gallon, and we would have 4,000 gallons to sell. So 4,000 times 250 gives us 10,000. If we sold this as gasoline, we would only have 3,200 gallons, right? Because remember, we had 4,000 gallons, 800 was lost to evaporation, which leaves us with $200 gallons times $3.50. That gives us the 11,200. The problem told us that the cost of the batch of making the kerosene was $2,400, and the cost of making the gasoline, the incremental cost, were $3,050. So when we look at the difference here, if we sell it right now as kerosene, we'll be netting $7,600. If we process it further and then sell it, we'll be looking at $8,150. So our differential revenue is $1,200. The differential cost are $650. The differential income in this case is $550. We'll be better off $550 in this case if we process it further. Okay, so the cost here, this includes just all, it says the cost of processing the batches, so that could include all sorts of different things. All that collectively was $2,400 for kerosene and $3,050 for gas. Sometimes businesses will receive offers to accept business at a special price. And at first glance, it might seem like a bad idea, but if we investigate it further and have put a good amount of time into thinking things through, we might come to see that it might make sense. In order to have a good, solid understanding of if it makes sense to accept business at a special price, we need to understand and consider the fact that some costs are fixed and some expenses or costs are going to be variable. Now, if the company is operating at full capacity, that means that the plant is running wide open 24/7, all the conveyor belts are moving, and there's no extra capacity, no extra room to take on the additional business. So if the company is operating at full capacity, any additional production increases fixed and variable manufacturing costs. So maybe they would have to add on to the factory or added an additional workspace for these people to apply direct labor. All right. Now, if the company is operating below full capacity, that means that there's some room in the factory. So maybe there's some extra space on the conveyor belts. Maybe there's some people that are there to work, that are salaried. Maybe there's supervisors that are there, and they could take on some more work, right? So if that's the case, additional production is not going to increase the fixed manufacturing cost, but will likely increase the variable. So if we make extra units of whatever it might be that we're making, and we have room in the factory, we're not going to have to add on to the factory. Or if supervisors that are paid a fixed amount have extra time, we're not going to have to. They have additional time to supervise, or they could handle supervising more work. So that's not going to be an additional or incremental cost. But if we're making nuts and bolts or cereal or whatever it is, the direct materials and direct labor costs would likely increase. So for B-Ball Incorporated, they manufacture basketballs, and currently their monthly productive capacity is 12,500 basketballs, and they're only selling 10,000 basketballs. The normal selling price is $30 per basketball. Okay? And when we look here at the cost, there's variable cost of $12.50 per basketball. So the variable cost include direct labor and direct materials. Fixed cost, maybe this is to light the factory, whatever, that's $7.50 per basketball. So we're looking at a total of $20 per basketball with manufacturing costs split into these two components. On March 10th, B-Ball receives an offer from an exporter. They want to purchase 5,000 basketballs at $18 each. Let's go back here, and hey, we normally sell these for $30. So the first thought we're going to have is, no way, right? We sell these things for $30. But these people offer us $18 each. Production can be spread over 3 months, so these basketballs can be manufactured using normal capacity. So, what should we do now? I don't know. Maybe we can, maybe things are different. We have capacity. At first glance, it seemed like we should reject this offer, but let's take a look. Maybe it makes sense. So if we reject the offer, we're not going to bring in any additional income, but we're also not going to incur any additional variable manufacturing cost, right? We're not concerned with the fixed ones. We're concerned about the variable cost. If we do accept the offer, we're going to receive 5,000 units. We're going to sell them for $18 a piece, so that's $90,000. Our fixed costs are not going to increase because we have capacity. We have room in the factory, okay? But these variable costs for materials and labor, they're going to go up, aren't they? So 5,000 units times $12.50. Remember, $12.50 right there. Okay? So that's $62,500 of variable manufacturing cost. So we're looking at $27,500 of income. That makes sense for us to take on. If we go back here, if we had included these fixed costs, we would have been looking at $20 per basketball. And $20 per basketball times 5,000 units, that would leave us with $10,000 we would be losing if we made the mistake of treating those fixed costs as being a differential cost. But we know that they are not, right? So the variable cost we are concerned with, but not the fixed ones. So in this case, at first glance, we would have rejected it, but once we've split the cost between being variable and fixed, we see that actually we'd be $27,500 better off to accept this offer. If you've ever been stuck in traffic on the interstate at an on or off ramp, then surely you have a pretty good understanding of what a bottleneck is. So a production bottleneck or constraint is a point in the manufacturing process where the demand for a company's product exceeds the ability to produce the product. The theory of constraints is a manufacturing strategy that focuses on reducing the influence of bottlenecks on the production process. So we try to identify these bottlenecks wherever they are and do what we can to eliminate them so we can have a steadier, faster flow of production. If we take a look at Pridecraft Tool Company, we can see that they make three types of wrenches: small, medium, and large. All three are processed through a heat treatment operation which hardens the steel tools. Pridecraft Tools heat treatment process is operating at full capacity and is a production bottleneck. So throughout the production process, this is where there's a pile up of these tools. Okay, here, so we can see at first glance, we're thinking to ourselves, all right, $120 is the contribution margin. Remember, that's the difference between the sales and the variable cost for these wrenches. That's what we want to produce. But we have to take into consideration how much time it's spending in this bottleneck area. This one does yield the largest contribution margin per unit, but it takes the most time. So when we further analyze it, when we divide take the contribution margin per unit and divide it by the number of time spent in the bottlenecks, we can see here that we're getting $90 per hour of contribution margin out of the small wrenches, $25 for the medium wrenches, and $15 per the large wrench. Alright, so we only have so much time. We're at full capacity. We only have so much. Assuming we can sell all of these wrenches that we're making, we would be best off to spend our time making these small wrenches, right? That's the most contribution margin per hour of bottleneck. So that's where we want to focus our production. Pridecraft Tools can improve the profitability of producing the large wrenches by any combination of the following. So maybe there was more of a demand for large wrenches. For whatever reason, if we wanted to increase that, we could increase the profitability of those large ones. We could either increase the selling price, that would drive up the unit contribution margin. We could decrease the variable cost, that would also increase the contribution margin. Or we could decrease the heat treatment hours required for those large wrenches. Thanks for taking the time to check out this video. If you have any questions, please let me know, and have a great day.